Ladies and gentlemen, there is something happening in the economy right now that I do not hear absolutely anybody talking about. And this one indicator, I think, in my opinion, is not signaling that we are facing a recession, but it is signaling that we could possibly be facing a depression. Because a lot of people are already saying it already feels like we're in a recession, but there is so much economic pain coming ahead. There is so much signs and indicators that telling us it is going to get worse. And we got another indicator today that tells us, yes, things are going to get much, much worse. But again, I don't see anybody talking about it. So this is a very, very important video I want to make to explain people what this indicator is, what it means, and how we can prepare. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. So what does this indicate, everybody? This is the price of oil. And the oil markets have taken a huge, huge shift over the past month. Look at this. On the 13th of April, crude was at $83 a barrel, and it's fallen all the way down to $69 per barrel. So again, why is this such an important indicator, and what is causing this massive sell-off? Well, let's have a deeper look, everyone. So look at this. Again today, oil falls 4%, extending losses after the Federal Reserve's rate hike. So I went over previously in my video how the Federal Reserve lifted interest rates by another 0.25%. But something actually interesting that's happening, many people would have thought that the dollar would have gone up today, but it actually went down, but also oil went down. And what that tells me is we're going to be facing some big risks for the economy. Because what normally happens when the economy is booming, people tend to travel more, people tend to drive around more, there's a lot more demand for goods, so there's a lot more trucks driving on the road. So normally oil price goes up when the economy is booming. But what oil actually does, or what it can signal if the price is crashing, it's signaling that there is going to be much weaker growth and much weaker demand coming ahead. Because again, look at this chart. This is the DXY, the dollar index. We can see here it hit a high last year in September of 114, and it's now fallen over 10% all the way down to 101. So normally when the price of the dollar goes down, commodities like oil goes up. But the opposite is happening, everyone. So let's have a deeper look into this report on why the price of oil is falling, and then I'll break it down for you in very, very simple terms, what this means for the economy. And we all have to pay attention to this, because if things do get as bad as I think it could, your job could be on the chopping block, and times are going to get very, very tough indeed. So first thing, investors fretted about the economy. Again, when the economy is not looking good, oil price falls, and the oil price is absolutely crashing right now. But what's also more concerning is this is coming off the back of a 5% drop yesterday. So it already crashed 5% yesterday. This was all traders trying to price in the worst, but then we had another massive drop today. So that's telling me that things are only going to get worse. So again, they're saying here that the Federal Reserve lifted the interest rates, which is pressuring oil prices as traders worried that slower economic growth could hit energy demand. That's exactly right, one. Like I was saying, when the economy weakens, there's less people traveling, less people ordering goods, and there's less demand for oil. Now, the thing is, oil is falling so much, like I was said, this means that this isn't just going to be a weak recession or a mild recession like the Federal Reserve, like the banks, like all these analysts are telling us. The price, the smart money, follow the money, they're telling us this could be a depression. But the Fed also signaled it may pause further increases, giving officials time to assess the fallout from recent bank failures, wait for a resolution of the political standoff over the US debt ceiling, and monitor inflation. So this is a very, very sticky situation the Fed is facing. We still have record high inflation, but the economy is falling off a cliff, unemployment rate is going up, and also, normally when there's a recession, the Federal Reserve can print money, they can stimulate the economy, but they can't do that this time because of inflation. Also, too, the US government is bankrupt. They don't have any more money. So they're not going to be able to, give away $1,000 stimulus checks anymore if we do face another recession like 2020. So this is what we call stagflation, everybody, where there's weaker economic growth and higher inflation, and there's absolutely nothing the central banks or the government can do about it. But there's also more pain coming for the global economy. It's not just what happens in the US. We have to pay attention to what's happening with Europe, also what's happening with China, the second biggest economy in the world, and also what Russia's doing with their barrels of oil as well. So the European Central Bank is expected to raise rates at its policy meeting on Thursday. Also pressuring oil prices, government data showed US gasoline inventories unexpectedly rose by 1.7 million barrels last week. Analyst poll by Reuters had expected a 1.2 million barrel drop. So this is an absolutely huge miss, everyone. They were expecting oil to drop by 1.2 million barrels, but instead they actually had an increase of 1.7 million barrels. So this is showing there's a lot less demand out there. So there's going to be more rate hikes in Europe, which is going to put pressure on demand in Europe. We've seen the inventory is rising in the US and there's weaker economic growth in the US. But again, what's happening with the second biggest economy, China? In China, data over the weekend showed April manufacturing activity fell unexpectedly in the world's largest energy consumer and top buyer of crude oil. So what this is telling us, not only we're going to see weak growth in the US, weak growth in Europe, but also China, the world manufacturer, the supplier for the world, they're seeing a sharp contraction in manufacturing, and this is going to mean there's going to be not just a US depression, but a global depression. There's also downside risk to Russia's supply and upside risk to China's demand have largely played out, and the prospects for 2H tightness have weakened, the bank said in a note, referring to a buoyant exports from Russia despite Western sanctions. So again, despite sanctions from the West, Russia is still exporting a lot of oil, and that's putting a lot more oil on the market. Other countries are buying this for very, very cheap. So this is also putting downward pressure on the oil price as well. So I know we're thinking, well, okay, what does all this mean for you in simple terms? What this means, everyone, like I said, I can't believe nobody's talking about this. This is signaling there's going to be a huge contraction in the economy coming. And unlike other times when the central banks could drop interest rates to save the day, when governments could just take on more and more debt, print more and more money to save the day, they're not going to be able to do this time. Because what have they been doing? They've just been kicking the can down the road again and again and again. But eventually the road ends and they have to face the music. And the only way we're going to get out of this is to let the markets crash, let the economy crash, because this is an inflated market, it's an inflated economy. It's not a market based on fundamentals of supply and demand. So this is the correction that we all need so things can get back to normality. But everyone, what do you think about this signal? I thought it was very, very interesting. Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.